Everyone, this is Rob Roy, and welcome to the special live stream of our Ellie Wave Options U.S. market update. Hey, if you like these recordings, please hit that like button, or better yet, hit subscribe, and you'll be notified immediately when one of our recordings is posted or when special events like this live stream are posted, and you'll be able to watch us. So thanks, we appreciate it. It really helps. All right, taking a look at this, by the way, appreciate you spending a little time with us on your Friday night. Promise not to take up too much of your time, but I do invite you to stay till the end because we'll do a little bit of Q&A at the end of the presentation. So taking a look at the markets, you can see that another up day started a little bit lower. Not
Hey,
quite.
Rob, sorry, we can't see your screen. There we go.
Thanks. There we go. There's the market. So taking a look at the move to the upside that we had today and following the past couple of trading days, same story. Start a little bit lower and then rally throughout the trading day. And you can see that we're still in this upward zigzag pattern that we've been talking about that brings us up into the 430s on 100% extension. But we do have some resistance ahead around the 61.8% fib level right there around 413. So we've got to get through that first. I do like the fact that this is in a 45-degree angle, though. I think that move is pretty impressive. And when we take a look at the moving averages, you can see that we're a little bit overbought, but we have been for a couple days. Remember the rule, no security in any time frame gets very far away from the 10-day moving average. So a little bit of separation there. However, not a whole lot. And it seems like the market does want to move up into that 410, 413 area before we run into any sort of resistance, and we'll see if that backs us down a little bit. Some people, the talking heads on the financial networks, were saying that 400 was acting like a brick on the head of the market. Well, I guess we did bounce down from it a little bit, but we've moved through that and continued to move higher. So that zigzag looks pretty strong moving to the upside. We'll look at some of the other markets as well. When you take a look at the Dow, you can see that we're in a wave 5 pattern to the upside here. The wave 4 has labeled. Little different pattern on the Dow than some of the others, but we'll talk about that in just a second. But with a 50% wave 4 correction and a move to the upside, that looks pretty strong as well. Not quite the same kind of movements as we've got now the other markets. I'm going to bring something up regarding that here in just a minute as well. But we did hold 330, and now we're having a little bit of resistance here at 340, which makes sense because there's resistance back in August. But a doji here. Maybe we need to back off just a little bit. I don't think any sort of sideways consolidation, even a little bit of a move back to the downside, would be too bad for the market. In fact, I think it would be constructive for a potential to move higher. When you get overbought and you can continue higher and you get more overbought, that's when you get more significant corrections to occur in the market. Taking a look at the Qs, you can see that, all right, so moving to the upside here in the Qs, and we are just a bit overbought here. We've talked about this for a while. If you've been watching any of these recordings, how the Qs so underperformed as the market was dealing with the Fed's rate hikes. And we said that once we come out of that, the Qs will be the place that outperforms. That's just how things work. It underperformed before, it's going to outperform, and it has been doing that. And we have this separation here from the 10-day moving average, a little bit of resistance here ahead at the 300 level. So again, another sign that things look pretty constructive in the market, at least for now, but perhaps we need a little bit of time to take a pause before we move much higher. I did want to show you the 10-year. As you can see here, consolidating this wave 5. To me, this is extremely constructive. If you watch any of our trade finders, and by the way, if you haven't attended a trade finder, we talked about Tesla, which we'll talk about here in a few minutes as well. And in the last couple of trade finders, Zach will put the link in here for those of you that are watching live. You can click on it if you haven't registered before, or you can go to a website, our website, if you're watching the recording of this, at ewotrader.com and register for Trade Finder there. We do it every Tuesday night at 9 p.m. Eastern. It's free. We talk the markets, we look for trade ideas, and we do a Q&A at the end of that as well. So love to have you. I mean, we get some great questions, a lot of great stock symbols to look at. It's a lot of fun that we do every Tuesday night. But I've been talking about how if we stay in this trading range here, then I think that's really constructive for the markets, as well as the fact that the dollar has stopped some of these I'm a strong dollar fan, as you all know, but not as strong as we got, because that's pretty difficult for international companies with the exchange rates to deal with. So the dollar coming down, I thought was very, very constructive for the markets, but I didn't like these vertical moves. So I like the fact that we've kind of stopped that. We're doing a little bit of a drift lower. I think that's ideal for the markets. The wave 5 is at a 38.2% fib level. So that's allowed it to kind of go sideways here, as that's acting as some resistance on the way down. So as long as the dollar stays above 96, I think that bodes well for the markets moving forward as well. But what's negative? What's negative for the markets? Well, if we take a look at the VIX, we talked about this in last week's recording. In fact, I asked y'all, do you think the VIX goes lower? Do we break below this area at 18 that has acted as the floor for a while? Or do we move up and test that level up here around 26? And a lot of you seem to think that we're going to move lower, which is interesting. And so we have. So as you can see here, we're down. The low of the day was 1797. So we tested that low there at 18 and closed pretty darn close to it. So are we going to make a new wave 5 here? Perhaps that can go down to 61.8%. I really have a hard time believing that the VIX is going to go below that. But hey, stranger things have happened. We talk about how the VIX spent so much time in the upper end around 35. So just because we're down here, and granted a low VIX, which you would think that the path of least resistance would be for the VIX to move back to the upside, which normally coincides with the market moving lower, as you know. But would it be so out of the realm of possibility that we just spend some time now in the lower end of the range of the VIX? Just kind of offsetting what happened over the past year, where we spent so much time with an elevated VIX. I don't think that's unreasonable. Now, getting this low, yeah, we need some bounces, but the market never moves straight up or straight down, and it's not going to move straight up either. So we'll have some impulses and corrections. That's why we like LA Wave so much. That's what LA Wave tells us. Now, something else that I wanted to talk to you about before we take a look at the chart of the Russell here, wanted to talk to you about something called the January effect. I'm curious if you guys put any weight into the January effect. If you've heard it before or weren't sure what it was, or maybe you've never heard it before, as you can see, it's considered a hypothesis. And the markets, if you view the efficient market theory, then you would say this is just BS, this is just coincidence. But in general terms, what the January effect says is that small caps tend to outperform mid and large cap stocks in the month of January. This was first discovered back in 1942, as you can see, by Sidney Wachtel. He noticed this, and it's been pretty consistent over the entire 20th century as a historical trend. Now, nothing's 100%, nothing works every time. This doesn't either, but it's worked enough to where it brings conversation. And so if we take a look to say, okay, what's happened this year so far? Is the January effect working? Are small caps outperforming the regular market? Well, here's the year-to-date returns on the SPY, and you can see up till now, from starting at the end of the year, the S&P is up 5.8%. Pretty good start to the year. But then when we look at the IWM for the small caps, we're up 8.14%. So at least so far this year, we're showing that, yeah, the January effect, or the so-called hypothesis, has been in play. In other words, small caps are outperforming the regular market, at least thus far in January, and it's more efficient towards the middle to the end of the month, which is why I wanted to show it to you now. But I'm curious as to what you think. Do you have any belief in the January effect? Do you think it's all hocus pocus, or do you think there's something to it? Post a comment underneath this video if you're watching the recording, or post it in the Q&A. I'm just curious to take a look at it and see what y'all think. But when we take a look at the chart of the IWM, you can see here we are right at that 190 level. We've been talking about this for a while. Can we get through that level? Can we get through 190 and move back into the area where we're trading between 190 and 210? That was the trading range before we broke below 190 and set up a new trading range between 170 and 190. But we're in a wave 3. So you see that wave 3. We go back and look at the Qs. They're in a wave 3. Both of those charts have relabeled and moved into wave 3s to move to the upside. The only one that hasn't done that yet is the S&P, but we have that zigzag pattern. So that's a pretty good pattern. I'm a big fan of zigzags, as you know, so that's shown a pretty good strength there. So kind of the markets are all looking fairly constructive. The one that's relabeled the most is the Dow. Is it leading again, the fact it's had a wave 4 correction, or is it lagging because it needs to move back into a wave 3? Interesting talk that we've had over the last number of months, as you know, on whether or not the Dow is the market leader now, or is it taking a backseat and we're getting the emergence of the Qs and perhaps the IWM. So I would, again, welcome your comments. If you're curious about mine, I think that it shows, in general terms, I do believe there's more of an appetite for risk in the month of January. People get their end of the year bonuses, things like that occur. It's the start of a new year. And I think just in general terms, there's a higher appetite for risk, hence the money moving into small caps. Part of the other argument is, well, that shows because the small caps are less liquid. I don't really know if I buy that as far as any sort of an effect. I just think it's people's willingness to take more risk or put some money in small caps. You know, you got bonus money, et cetera. Maybe that's extra money, and that's kind of where that plays out. But in general terms, the reason that a lot of big traders look at that is that if there is a higher appetite for risk, it tends to bode well for the rest of the year. Now, I do think we'll have a correction at some point when we start to see the recessionary data come in, but overall, you know, we may have a constructive year when we get together at the end of the year and start taking a look there. All right, looking at some of the stocks of interest, Bitcoin getting up to 24,000 here. We talked about this Tuesday night in Trade Finder as well. If we got up to 24,000, you'd want to see it rest a little bit because we were getting just a bit overbought, and it's doing that. We're going sideways here around 24,000. If we can break above that 24,000 level, then the next stop is 28. Remember that it worked to the downside in those blocks of 4,000. It's going to do the same thing on the way back up. Every one of those levels that was resistance on the way down is now going to be resistance on the way back up. But pretty impressive move from 20 to 24, in my opinion, without any sort of a significant give back. Just kind of going sideways and then moved up again. Looks pretty darn constructive there as we move in towards the beginning of next year and the next halving process that occurs, which is typically bullish for Bitcoin and the cryptos. Tesla, holy cow, we talked about this in Trade Finder as well. If you watched any of these videos over the past couple of weeks, you know that I've said, hey, I felt like Tesla could go up to 160. Why did I say 160? Well, another one of the rules, in addition to that 10-day moving average, is the fact that vertical moves get retraced. And so we kind of were working our way down here with Tesla. But then once we broke 160, the move to the downside was pretty vertical. And so I felt like that would get retraced back to the upside. And we did send out an alert to our subscribers to take advantage of that move back to the upside. But holy cow, we got out way too early. No way did I think we were going up to 180 today. I thought 160, especially with the doji yesterday, following their very impressive earnings report, that we might rest there a little bit, go through some consolidation, perhaps even come back and fill this gap. No, just powered higher today. We are at another area of resistance here, and it almost looks like Tesla would be a good short-term short here because we're so far away from the 10-day moving average. But man, the two stocks that I would be most nervous about shorting are Tesla and Apple. We did do a downside trade on Tesla on the way down. We got out of that too early as well, but that vertical move, it's been retraced now. So I do expect some backing and filling. I'd be stunned if Tesla just powers through 180 and continues higher, but you know, that stock defies logic a lot. But I really think that we're extended now on Tesla. And so some backing and filling, if you've been part of this move, congratulations. Hopefully you were in it longer than we were. Apple's the other one they said I don't like to short because they have so much money, and pretty impressive move on Apple. Man, Ellie Wave nailed this wave 5 move. If you've been watching for the last number of months on the way down, a lot of people thought there was no way it would break 130. It did, because that was some support going back to June. We did go down there and hit that wave 5 target, and now we're bounding back to the upside. The eventual target on Apple is going to be back up here to 155. We'll highly likely retrace to that previous wave 4, but it doesn't always do it in a straight line. It has been a pretty good 45-degree angle. I think that's pretty impressive there as well. We are a little bit overbought short term on Apple too. So I don't know, maybe the markets are telling us we rest a little bit at the beginning of the week next week. But man, the moves have been quite impressive. Y'all are talking about Lucid through the social media platforms today. So I thought I'd bring that chart up. Pretty nice bounce there. And we're at that 23.6% wave 4 target. Now it labeled a wave 4 there in this overall move lower, but I do want to highlight that if you've read the works of Elliott, he acknowledged that that is technically by the rules a corrective level because it's a fib level. Elliott was a big believer in the relationship between Fibonacci ratios and Elliott wave. So he would label that, but he wasn't much of a believer in that holding. In other words, if Elliott saw this, he would say, okay, we're going to label that as a potential corrective move. However, he really liked when the corrections moved to 38.6%. So his view is that this is kind of an impulse that's not done yet. Even if we pull back a little bit, we're likely to continue higher from here. And so if we take a look at this zigzag pattern right here, you can see that the 100% level there is around 10. So it seems like higher likelihood that we continue a little bit higher here, get up to the 10 level, and then we'll see if we do an extended C wave and get up to 161.8%. And that would be more in line with what Elliott's view was. That would probably be around a 38% corrective level. And we might have a little bit of trouble once we get there. Thought I'd show you oil. We take a look at oil. We broke above 70. We've come down and tested the 70 level. And I think that that's pretty constructive as long as it holds in this area. So we're right at the 10-day moving average. We have been for a number of days. It seems to me with that wave 5 at 83% that oil wants to go do the retracement back to the previous 4. So the eventual target on oil is 80. However, if we break back below 70 with follow through, we have to take another look at that. But unless we do that, I think 80 is likely the next target for oil. And then looking at the SLV, really excited about an opportunity to go long here, but just waiting for this consolidation to clear out. GLD is doing it as well. You can see the doji that we have today, but just this really nice channel of consolidation right around 22. We break above that, and I think there's a great chance we go up and hit that wave 5 target up around 24 or so. But I want to see a break back above 22 before I get in. So it's on my watch list. I'm keeping an eye on it, but a break above 22 with a follow through day. And I think that could be a good long going to the upside. All right, that's what I wanted to share with you on this Friday evening. Zach, if you're there, if there's a couple questions from our viewers, I'm happy to take them. If not, we'll send everybody off and hope they have a great weekend.
All right. Yeah, no, thanks, Rob. We definitely have a few questions here for you if you're up for a few of those before we go into the weekend here.
Sure, let's take a couple.
So it was actually funny is about simultaneously when you were talking about the January effect, Danny here from YouTube says that referencing old photos of FSR running up at a similar time years ago and during the January effect there.
Yeah, it's been around for a while. One of the things that I like to talk about is that old school things become old school because they stand the test of time. And so, whether you believe in it or not, it's something that has been around for a while. So here's the chart of FSR, if that's what he was wanting to look at, another automotive here. And you see that pretty good consolidation right through here. And, it's the longer it consolidates and holds that, the better chance it has of bringing back to the upside there. So, but yeah, I mean, it's an interesting theory. If nothing else, gives us something to talk about. Everybody has their own beliefs. That's why I was curious as to what you guys thought, if there was anything to it. I gave you my opinion. I do think in general terms, there's more of an appetite for risk in January for whatever the reason is. So I think, looking at the small caps in the month of January makes sense. All right, couple more.
Alrighty. Next up, we'll go with Jess, who would like to look at NAS and AZ.
All right. So this looks like municipal bonds, perhaps. Not super familiar with this, but you take a look at the move back to the resistance level there at 12, and the wave 4 is not quite 38%, but moving up. And we looked at the 10-year, and so I think that some consolidation is warranted here, even if we move back to the upside, as long as we stay in that trading range that I mentioned on the 10-year, the TNX. I think that's, I don't think it's so bad if rates creep a little bit to the upside from here. What I don't want to see is the rates tank to the downside. If that happens, that means why is that occurring? Money is moving into bonds and bond prices and yields move in inverse proportion. So if yields are going down, that means people are buying them. And if it goes down significantly, I know the Federal Reserve is about to stop their rate hike campaign. Canada's already done it. They've already stopped. They announced that this week. So we're going to see the end to it at some point. But if bond yields continue down too severely, that means that people are leaving the equities market, and that's not constructive for equities moving forward. But a little bit of a break higher here, I think, would be okay. I actually would prefer not to see this wave 4 hold and move down to that wave 5 level. I think that's too low in yield. So trading in this area here somewhere, we stay around this 11 to 12 level. I think that's constructive, but wouldn't be too surprised if we break above this 12 level. If we do, then the next resistance is 12.5, which could occur there. But interesting chart. We don't look at that very often. So thanks for bringing that one up.
Yeah, absolutely. I agree. So how about 2 more questions? Does that sound good?
Sure.
All right. We'll go with one here from Go Fish. How's EFA and EEM looking? We covered EEM last night, so maybe just a brief overview on that.
Yeah, I'll take a look at it again. And I know a lot of our YouTube viewers ask about this, and I do think that it's a place to look for capital, to place capital moving, especially if we start to get a bit overbought here in the U.S. I know a lot of people say that, hey, if the U.S. catches a cold, or if the U.S. sneezes, the rest of the world catches a cold, that type of thing. But when we look here, to me, I want to see this break above this 43 level. I feel like kind of missed an opportunity here. Was watching this 41 level, and then just this gap and move here. I just felt like that was too much of a move to chase. So I wanted to watch this and see how we handle this overbought condition that we got up to. And it's very constructive. I think the EEM looks great. If you're long, congratulations. I wouldn't get out. If you're looking for an entry, if you're aggressive, go ahead and do it now, because I do think, following the Elliott wave rules, we're likely going up to this level here around 47 on the wave 4. So I think there's more upside. If you're more of a conservative trader, let it break 43 first. Maybe we do some backing and filling here, maybe not. I don't know. It's a pretty constructive chart. But breaking above 43 with a follow through day, I think gives you the green light for the retracement all the way back to the 47 level where the previous wave 4 is. That's likely where we're going. It's just a matter of when we get there. But looks pretty good to me. I mean, I really like the EEM. I know y'all have been on it for a while. The DMI is saying that, maybe we need a little bit of rest here. Strongest part of the move is likely over, but I just want to make sure that I'm clear on that. When it says that the strongest part of the move is over, it never means the entire move is over. It just means that if we go higher, you just want to be a little more cautious as we go higher, which is another reason why I want to see if we have a little consolidation here at 43, maybe even come back and test 41. I think that would be ideal for an entry, but it may not do that. We may just go sideways here. But my entry for me is we break above 43 with a follow through and let this DMI reset up a little bit here for more momentum to move forward. But yeah, pretty interesting on the EEM.
Very well. All right. We'll finish things up tonight with this last symbol from Will asking, you still hold PANW?
Yeah, Palo Alto, taking a look, cybersecurity, that's a pretty good move there. As far as still holding it, the DMI is just now setting up. I've been watching this one myself. as one that I wanted to look to get into. Now, the concern is probably it's still in a qualified 5-wave pattern to the downside, and now the wave 4's hit 50%, and we're at a ton of resistance here at 160. So, if you've been long and you've taken this move, I don't know, it wouldn't be such a bad idea to take gains, but the DMI is setting up like, hey, we're going to break through that 160 level and disqualify this downward pattern. But it's a ways from doing that. We got to go all the way past 78% on this wave 4 before the 5-wave pattern becomes disqualified. So, looking at the LA wave pattern, we use our confirming indicators for just that, confirming what we see in LA wave. In this case, they're showing different things with this 5-wave to the downside pattern here, but the DMI setting up and showing that all it's telling us is that, hey, there was some strength to this move. And when there's strength to it, then you have to be prepared for the possibility that maybe we break above this. But man, there is a lot of resistance at 160. And so if it was me, obviously I can't give anyone individual investment advice, but if it was me and I'd been in this, I would take the gains now and wait and see if we break above this 160 level and look for a new entry there. I wouldn't want to risk the gains that I'd made already on the fact that the 160 level holds and we do start back to the downside. So again, the encouraging thing, the DMI looks pretty strong, but it's got to break it. It's the Missouri thing. Yeah, you got to show me. Saying there's strength here, but actually do it. Actually break above 160, because that is a pretty hard ceiling there. Look how far we go back, almost a year, where 160 has been resistance. So I think I would be looking to take gains here and wait and let it show me that it can break that and then move from there. Thanks so much for spending a little bit of your Friday evening with us. Appreciate you hopping on here. Hope you have a terrific weekend. Look forward to talking to you again soon. Take care.